Interest rates are cut again. The Fed recently voted to cut those rates. We're going to talk about what that change means for you, your investments, and your retirement savings. Welcome to our show. This is What Your Money Would Say with Andrew McNair. He's founder and CEO at SWAN Capital, and he's here to fill us in on the background and shed a little light on what we can expect now. Thank you so much for joining us today. I am Luann Fulmer. Here's our phone number, 800-848-8768. That is the number that you can call or text. If you want to just text, if you're a texter like me, text the word SWAN and you can get on their calendar a complimentary visit to talk to Andrew and our awesome team at SWAN Capital about your questions. You can also text the word book. Andrew has a couple of books that you can get complimentary. That number again, 800-848-8768. Find us online at swan-capital.com. Andrew, so excited to get started with you today.
Oh, me too. We have so much to unpack and talk about.
I know, we do. Okay, so, interest rates now have been cut. I want you to kind of fill us in on that background. We've been hearing it, in the news. We knew it was going to happen. You knew it was going to happen.
I mean, even in 2023, they were like, we're going to have 6 rate cuts in 2024. The Fed is going to come, put their cape on, and save the day. And we now are obviously, in October, and we've had this one rate cut of 0.5%. There was discussion of a 0.25% cut, but the Fed chose, in this case, to be more aggressive. And this really is the benchmark rate, which before the cut was at the highest point in 23 years. So it was that high because of several rate hikes that were introduced to obviously combat the inflation that we've seen from the pandemic and afterwards and the aftermath of that. And so we haven't got 6 cuts by any means. And I personally always like to make sure everyone knows my opinion. I think the Fed should keep interest rates higher. I know that's very controversial. I know people want the Fed to lower interest rates, but what's best for the economy is keeping these interest rates higher to get rid of inflation once and for all.
Okay, very good. So I want you to hear Jerome Powell. He's the chairman of Federal Reserve. I think everybody knows that. But this is what he had to say on the recent cut. So here he is.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Okay, so what's your reaction to that?
Yeah, Luann, to translate all of that, it's basically saying that there's a dual mandate, that Jerome Powell wants inflation to stay ideally at 2%, and he's not willing to let the jobs market crash to make sure that we keep inflation at 2% or under 2%, that they'll be okay with a little bit higher than 2%. So he's really balancing and juggling, which, again, I personally believe that the Fed and the emphasis on the Fed is not healthy for a capitalistic economy. The Fed, the government, does not decide interest rates. The market should be deciding interest rates. Unless you want to live in a socialistic, communistic government. I mean, that's what China does. China tells what the interest rates, it tells what's going to be available for the private markets that exist within China. And so I don't think it's a healthy trend for us to have such an emphasis on the Fed, yet every market analyst, every financial advisor, every mortgage broker keeps such a close eye on the Fed. And I think it's very dangerous because you are manipulating artificially the economy. And that's where Adam Smith's Economics 101, the invisible hand, starts to slap your hand, because you need to let the market do what it needs to do.
Okay, very good. I love that. I like hearing your input there. Talk about how these lower interest rates can impact retirees. That's our main focus here.
Yeah, I think a lot of clients were really enjoying the mirage of higher interest rates in this desert of inflation. So they finally saw a money market, a CD paying 4 and 5%. And you heard it right here on the radio show. I kept on saying, this is a mirage. This is a little oasis, but it's going to dry up, and that well is going to dry up eventually. And you're going to still be in the desert of inflation. Whenever money markets or CD rates go up, again, that is a canary in the coal mine, just really really letting you know how bad inflation is. No one digs up a CD from their great-grandmother's estate and says, wow, we've made it rich because I found a 100-year-old CD. No, that's not what they were designed to do. So again, I know a lot of retirees have taken a lot of comfort knowing that interest rates are higher, but that is not the long-term tool to beat inflation. So we have to make sure that we do, of course, have emergency funds in place, maybe 6 months to a year of cash set aside, but we also need to have inflation-fighting assets such as owner finances on a house you've sold, real estate, equities, any asset that over a long term has beat inflation. And that is what I think is really important to emphasize for a retiree.
Okay, and today we are offering a chance for our listeners to come in and see you, get the SWAN sleep study. So talk about that and how I bet you guys are talking to your retirees a lot about these changing interest rates, aren't you?
Absolutely. So we've been trying to lock in some of these high rates in some of the fixed and guaranteed markets because we knew that it probably wouldn't last for long, that eventually the interest rates would have to come back down a little bit. So we were able to do a lot of refinancing of things that they had in CDs and MYGAs that were renewing at really higher interest rates, and we wanted to lock those in. So if you're in that situation where you have the majority of your money in the G fund, maybe you have your money in the stable value fund of your 401k. Maybe you have your money sitting there on a CD and you're really playing the game Frogger, jumping from one CD. They call it a CD ladder, but I call it Frogger because you're jumping from one CD to one bank and you're doing all that work just to earn more interest to pay taxes again because CDs and money markets are taxable. And you say, hey, I want to get off that treadmill. I want to get off that ladder and find some higher interest rate investments that are ideally tax advantaged. That's what we do here at SWAN Capital. We're not just looking at the investments. We're looking at the estate planning because we have an estate planning attorney. We're looking at the tax impact of the interest that you earn because we have a CPA. And then we're looking at the investment and making sure that it's a part of an overall financial plan. So if you want to get a second opinion, you want to make sure that you're really doing the best you can for your family in preparation for retirement, give us a call at 1-800-848-8768. That's 1-800-848-8768.
And remember, we've made it easy for you, too. You can text the word SWAN. If you like to text, just put in SWAN, and then you can communicate that way with our team. Okay? So thank you so much for joining us. I'm Lou Ann Fulmer here with Andrew McNair. He's president, CEO of SWAN Capital right here on the Gulf Coast, actually coaching retirees, pre-retirees, and retirees just like you. We're so happy to have you along with us today. So, all right, we're talking about interest rates. Latest news, they've been cut. I want to talk about, you kind of touched on it a bit, but the benefits for consumers when these interest rates start to come down, Andrew.
Yeah, I mean, it's great for your grandchildren. It's great for your children because obviously they're getting lower mortgage rates, which is really fantastic. To have your children and grandchildren finally get across the finish line of the American dream, to have their own home and start to pay down their own mortgage instead of renting from other people, I think that's fantastic. And I have many millennial friends that have delayed on buying a house, and now they'll get another chance if interest rates come down. And again, interest rates are not really that high at 5% and 6%. That's actually historically pretty average. So I think we should take advantage of where we're at. I know home affordability is off the charts, but this is why families need to save more. And if they can finally get in a home, that'll be fantastic. So never stop encouraging your grandchildren and children to get the down payment in order so that they can become homeowners. But if you're retiring and you're thinking, well, what does this interest rate cut mean for me and my retirement? Well, it means that we have to be more creative, that because interest rates are not yielding as much, then we have to make sure that we're looking at other investments. One investment that does really well with lower interest rates is real estate. So many of the real estate investments that we've helped clients invest in, if they're an accredited investor, they have over $1 million net worth, they have access to some of our investments in real estate, like our Signet Fund, CYGNET, a baby swan. And that is actually very good when interest rates go down because we're able to sell those properties to someone else. So again, this is the beauty of having a good financial plan. You should be riding the headwinds and tailwinds. The tailwind of the stock market over time growing in value, you should be riding the headwinds and tailwinds and adjusting your sales based on interest rates. Same with real estate, and same with any different headwind or tailwind that affects the economy. And again, if you don't know how to sail, I don't either. You need to find someone, a sailor that has went through these choppy waters before, so they can help guide your sail.
Okay, very good. All right, so we are inviting you to come in and see Andrew, talk to him about your current situation. Andrew, let's talk about your locations real quick.
Yeah, we have two offices. We have an office in Pensacola, Florida, right there in downtown Pensacola. But we also have an office in Daphne across from the Daphne Police Department. So it's like the safest location there is because it's right there.
Yeah.
So it's fantastic to have those two offices and service all the families that are here on the Gulf Coast.
All right, and then you also hold events. I want to bring that up too, and people can search for those at swan-capital.com. But what events do you have here?
Yeah, we just had the halftime report. Twice a year, we rent out the AMC Theater, and we'll have hundreds of clients, and we actually open it up to the public if we have space, where I'll talk about the economy for the next 6 months and how the economy is going to be affected potentially by an election. We'll talk about how our portfolios have done. We'll talk about the headwinds and tailwinds that we still see in the economy, from everything from monetary policy to fiscal policy. And we do that twice a year for clients to keep them up to date. And so if you want to make sure that you don't miss our State of the Market that's coming up in January, it'll be here before you know it, definitely let us know. We also have community live events at Jesse's Steakhouse in the Grand Marlin all the time to teach families about estate planning, tax planning, as well as financial planning. And that's where we bring our attorney in to talk about wills, living wills, and trusts.
All right. So head to that website, swan-capital.com, and find out about the latest events, and you can sign up for them there. In the meantime, here's that phone number again. 800-848-8768. Text the word SWAN if you like to text, but get on that calendar for a complimentary appointment with Andrew. We'll be right back. Hey, thank you for spending part of your day with us today. I'm Luann Fulmer here with Andrew McNair of SWAN Capital. Gone are the days when retirees could rely heavily on a substantial external support like Social Security or a pension, right? Today, pensions are a fading memory. I mean, if you have one, good for you. But the reliability of Social Security benefits, that's also becoming increasingly uncertain. And so here's the deal. There's a huge burden on us financially to have a successful retirement, okay, ourselves, individually. So, Andrew, as a financial advisor, tell us what you see are some of the greatest risks that threaten financial security in retirement.
Well, the first one is increased life expectancy. You wouldn't think that that's a problem, but it actually can be financially. And even if you have a pension and Social Security, remember that your spouse is oftentimes not going to get 100% of what you have, because they're going to either lose one Social Security check, of course, but they're also going to have to get half your pension, maybe a percentage of your pension. So increased life expectancy for you and your spouse, it could actually be a threat to your retirement. And then market volatility, inflation, rise in taxes, rise in healthcare costs. I mean, all of those things can really affect your retirement and the ability not only to retire, but to stay retired.
Okay. Yeah, very good. So you've outlined a lot of challenges that retirees face. We do a lot of our shows about these very things. But in your experience of all of these, which issue do you think that most retirees struggle with?
Yeah, I think we all think that we're not going to live that long. We think we've lived very dangerous, risky lives. I know I didn't, for some reason, think that I was going to live this long. Well, Here I am.
Yeah.
I just have a lot less hair after finally reaching this age.
What do you mean?
And
you
so
shave it. You shave it.
I do. But on average, men who reach age 65 can expect to live until 84, Luann.
Wow.
While women who expect to live until nearly 87. So if you reach 65, you've come through a lot of things that could have happened. Maybe a heart attack, maybe cancer, and you've already made it through that or never have had it. And so if you reach 65, you have a longer life expectancy, obviously, than someone that's born today. So living longer is a very serious situation because it increases the impact of other risks like inflation, taxes, market volatility, and healthcare. Because the longer you live, the higher you're going to see prices. Luann, we talked about this off air, that right now strawberries, if you go back 20 years ago, in 2004, they were 48 cents, 43 cents a pound, but they're now $3.40 a pound. That means you saw prices of strawberries double in a 20-year period. And so I've seen that over my life, how prices can go up that drastically. And then next is, the longer you live, the more chances you're going to have some healthcare situations pop up for you and your spouse. And a lot of times people talk about, they talk a big game, how they're going to walk off into the woods, or I've heard some crazy things that they want a Viking funeral. And that sounds great and all. But at the end of the day, you probably will get to a point where you don't want to let your spouse go. You're going to take care of them because you love them that much. And so we need to plan for those things and not stick our head in the sand like an ostrich.
Right, yeah. Yeah, that's really tough, I mean, we don't know how long we're going to live, but yet we have to plan for a long retirement, just in case we do.
It's like preparing for a marathon.
Yeah.
And someone hands you one of those goops that gives you the calories, and someone hands you an apple and a water, and they say, yeah, just keep on running, and we don't know how long you'll be running for. And you're like, okay, thanks for the inspiration. And that's like retirement. You don't know how long you'll be running this race.
Right. I want to bring up the fact that we also need to plan for just one of us being left. I have to say, two of my best friends, Andrew, we are 65. Two of my best friends have lost their husbands here in the last
tragic.
year or so. So, yeah. So there is going to be, we know that surviving, there's going to be one after somebody leaves. And they're hit the hardest, aren't they?
Absolutely. I mean, many times we don't estimate properly what happens when our spouse passes with our income, with our investments, and also taxes, Luann. Remember that in this country, when you pass away, leaving your widow spouse, they actually could pay more taxes in this country. We make widows pay more because their brackets got cut in half. And so now they have an IRA that now they've reached RMD age. They're taking that money out as a single person, paying more taxes. And it's a real shame because now they're going to have to potentially live on what's left after taking care of a loved one in a nursing home and assisted living. So healthcare costs have eroded some of their investments, and maybe they didn't manage the investments their entire life, and they're thrusted upon this exercise of trying to manage the investments, pay bills, because oftentimes we split the tasks as a married couple. And so many families, when they're left with, I've never managed money well, they go start interviewing financial advisors at that time, and it's luck of the draw. Maybe they meet the Wolf of Wall Street when they should have met the better financial advisor, but the spouse and them couldn't do it as a team because one of them was a do-it-yourselfer the whole time. And so that's what I've refused to do. Like, I manage the investments for me and my wife, but she understands that she has a binder that has our legal documents, our tax documents, our financial documents, all in one binder. And if something happens to me, she doesn't have a financial guy. She doesn't have a financial gal. She doesn't have a financial advisor. She has a financial team at SWAN Capital.
I love that. All right. And today we are inviting you to give us a call, because if you have questions about what we're discussing right now, anything regarding retirement, this is what Andrew and our team do at SWAN Capital. Okay. They want to help you feel confident that your retirement nest egg is set up strategically for a long and flourishing retirement. Here's the phone number. Call or text SWAN to 800-848-8768. Okay, call or text SWAN, 800-848-8768. It's a complimentary appointment to get in and see them, and they will take you through what they call the SWAN Sleep Study. Real quick, explain that. It's an acronym.
Yeah, it is. So sleep well at night is our goal for every family. I just don't like birds. Bird watching is great in retirement. It's not what I personally do, but I do want to help families sleep well at night. And so a sleep study is basically a report card that you don't want to hide from your parents. We're going to look at asset protection. We're going to look at income planning. We're going to look at tax planning, estate planning, all the different parts that represent a financial plan. Because we found found that a lot of people, they got statements, they have portfolios, but if you were to go down the street and do interviews down the street, most people, they have statements, but they don't have a financial plan. So we're going to make sure that you have straight A's going into retirement of all the components of a financial plan, and we'll give you a grade and tell you the good things that you're doing, but also the room for improvement. And it's complimentary. You can take our information and tell your advisor how to do their job. You can look it up on Google and fix it yourself, or you can hire us, and that's obviously what we hope, but that's not obviously a commitment. So if you can give us a call at 1-800-848-8768, we will prepare that sleep study for you. So again, that's 1-800-848-8768.
And remember, the website, too, is swan-capital.com. You can head there and find out yourself how awesome Andrew and the team are at Swan Capital, because I work with them all the time. Okay. Today, we're talking about what you can do to make your retirement money last throughout retirement. Again, we don't know the finish line, the finish date, but talk about steps that our listeners can take right now, Andrew. What can they do with their retirement savings to make sure that it's going to provide that income needed, throughout their years?
Absolutely. So if you're trying to build this at home, it can be done. I believe in a bucket strategy. I've seen it work time and time again. So a bucket strategy is where you divide your money into three major buckets. Bucket number one, we want to fully fund from years 1 through 5, and we want to prioritize protection and liquidity. Remember, every investment, this is a good writer downer, boils down to protection, liquidity, and return. And you can't have all three. I wish you could have all three, but this is not a perfect world. If you have an investment that's perfectly protected, has great returns, but also is liquid, that's called a Ponzi scheme, and you should get out quickly. So the first bucket, 1 through 5, we want to fund that with a lot of money. And here's why. You want to front end your retirement. Everyone's telling you that you only need to take $4,000 a month out, or 4% of your money out. Whatever that number is, don't think linear, because retirement is not linear. You're going to spend more money in that first 1 to 5 years traveling and doing the hobbies and the passions that you want to do. So we prioritize protection, liquidity. Number 2 bucket is we're going to make sure we cover years as 5 through 10. And so since we're not going to touch it for 5 years, we can prioritize return as well as protection. We still need to be conservative because we're going to use it in 5 years, but we can prioritize more return. So first bucket was protection and liquidity. Second bucket is protection and return. But the third bucket, even if I have a very safe, conservative client, which we're kindred spirits. Again, I named it SWAN Capital, sleep well at night. You should still have a bucket number 3 for 10 years and beyond. And that is your inflation fighting bucket. And that bucket should have, again, the prioritization of return first and foremost, and liquidity in the 10th year. If you map out your retirement income plan, inventorying your income, inventorying your expenses, creating a spending plan, and you bridge that gap with those 3 buckets, you're going to be better prepared for retirement than someone just that has a melting pot, a big pie graph of bonds and stocks.
Wow, excellent. So obviously, getting some tailored advice is so important. And I know this is what you guys do. You do a personalized retirement income plan. That's what this sleep study leads to, the SWAN sleep study.
Sure.
So again, give us the information. We do have to take a quick break, but we'll be right back. Go ahead.
Absolutely. So if you are going to try to build this yourself, or you want a financial advisor to build it, maybe you have a financial advisor, but you don't have an income plan. You're not sure what the maximum you can spend in retirement. You're not sure if your money will outlive you. That's the whole point of an income plan. So take us up on this sleep study. It's a complimentary 1-hour visit where we'll give you the probability of if you will run out of money in retirement. Wouldn't you like to know? I would like to know if I have a 98% probability or not. So you can give us a call at 1-800-848-8768. You can check out our website at swan-capital.com, but give us a call at 1-800-848-8768.
Up next, we're going to dive into strategies to navigate the challenges of inflation and healthcare costs and taxes. So stay tuned for more. Hi there, I'm Lou Ann Fulmer here with Andrew McNair. Thank you for joining us today. As we enter retirement and then all those stages of life, the financial landscape becomes increasingly complex. So, obviously rising inflation, stock market risk, shifting tax obligations as well. So, Andrew, let's explore how retirees can best manage all these financial pressures. Beginning with the challenge of the stock market, please.
Yeah, I mean, stock market volatility is a big threat to your retirement. When you retire, that stock market volatility is different than when you're in the accumulation phase of retirement because you can stomach the ups and downs and continue dollar cost averaging. Here's what happens, though. When families get closer and closer to retirement, they start to get naturally more conservative because the stakes are higher, the numbers are bigger. And what do families do? They rely on rules of thumb, Luann. They rely on things like the rule of 100, which is your age minus 100 and how much safe assets you should have. They will use the rule of thumb of at age 60, I should have this much in stocks versus bonds. They look at the rule of 4% or 5%. I think I can live off 4% without spending through my principal. All of these are rules of thumb. And again, I told a client just yesterday, we don't build houses on rules of thumb. I mean, we've come a long way where people used to measure, from their tip of their index finger to their elbow, and that's how they measured and built things. We have rulers now. We even have lasers now. So it's important to make sure that when we approach market volatility, we use a different approach. I always tell clients, I know you think you should become more conservative the older you get, but that's actually a fallacy. And people look at me like I've lost my mind. And I say, here's why. I have clients that retire at 52 and I have clients that retire at 72. So if we just use the rule of 100 only, if we just used age appropriate investing, that is not sufficient because it's based on the chapter of life that you're in, not your page number.
Very interesting. Okay, interesting. So another concern is taxes, right? We know that the taxes are going to go up because of our national debt. So let's talk about the current tax rates and how they're going to be changing soon. So talk about the possibility of rising taxes, please.
Yeah, it doesn't matter who's our president. And I know that sounds shocking. A lot of people say, doesn't this election matter more than anything? I say, absolutely not. I mean, economies hopefully are bigger than one person. Here's what happens, though. The policies that president enacts or keeps definitely impacts the economy. And what you can only do is vote. The second thing you should focus more on is focusing on your personal economy. What can you do to better protect yourself? Personally, me and my family, we've been focusing on our personal economy. Most of me and my wife's assets are in Roth IRAs, Roth 401ks, tax-advantaged assets like real estate, HSAs, which are tax-free, life insurance, which are tax-free. So the government may change the rules on future income. They may change the rules on different segments of our population. They may define what rich means. And they may actually put shade on the pursuit of our happiness. And they maybe make it harder to do better. But I can assure you that will not affect me and my family. Why? Because we're going to be 3 chess moves ahead of this really slow moving thing called a government, that bureaucratic thing that we call a government. And so this is why you need to be encouraged that you can take action. Like you can watch the news and say, wow, I'm really frustrated with how they're spending our money. We're going to make sure that we take action. Look what Apple did. Apple went so far, they actually left the United States and became a Guernsey country company and then became an Irish company. We always think that Apple's an American company, but they took action. They said, hey, if the country's going to change the rules, we're going to be 3 steps ahead. And I encourage you to do that for your family. Maybe not move to Ireland, but you get my point.
Okay, so let's go into the pressing challenge of inflation. Okay, we know we're going to have inflation all the years in retirement. So talk about how retirees can adjust their financial plans to cope.
Yeah, a lot of families have retirement plans that were built in 2020, built in 2018, that were built on a 2 to 3% inflation rate. And if you have a financial professional, what's the chance that they went back and changed that inflation rate on your income plan, changed it on your financial plan if you have one? Sadly, most families don't have a financial plan. What we know is about 20% of the population has a financial plan. And I assure you, of that 20%, it's a very low percentage that they went back and change that inflation rate to 4 to 5%. Over this decade, I truly believe that we're going to have an inflation rate of an average of 4 to 5%, which is not the 3% or the 2% that many financial plans account for. Now, you may have Social Security, and that's going to have a cost of living adjustment, but maybe your pension doesn't. And so we need to make sure that your investments have a fighting chance against inflation. You are going to have to face eventually healthcare costs that are increasing faster than inflation. And so this is where we're talking with families about not long-term care insurance, where they pay indefinitely and hope they never pay it. And if they never actually get the payment from that long-term care policy, the money goes down the drain. That's where we're actually introducing long-term care hybrids to families that have never heard about long-term care hybrids. So again, like I was saying before, you can control your personal economy. You can't control the economy. You can't control who's the president, but you can control what happens in your four walls.
Right. And that is why we are offering a chance for our listeners to give you a call, get on your calendar, and come in and talk to you and your team about these very things. How are they going to handle inflation in retirement? You have to have a plan. Plan for the worst. Hope for the best, obviously. Here's the phone number, 800-848-8768. You may call. You can even text if you like to text. Text the word SWAN to 800-848-8768. We've made it very simple for you to get on their calendar at SWAN Capital. And then remember, that website is swan-capital.com. And Andrew and his team would love to help you create that plan with the goal of helping you sleep well at night. That's what SWAN stands for. We're so happy to have you along with us today. This is What Your Money Would Say. I'm Lou Ann Fulmer here with Andrew McNair. Hey, Andrew, let's get into how you guys can help someone optimize Social Security.
Yeah, there used to be a lot more options with Social Security, but now oftentimes one of our best practices is that we help a client take it early for one of their spouses who has the less income, and then whoever had the most income, that income earner, that primary income earner, we help them delay their Social Security to age 67 or 70, because remember, Social Security is not a 2-for-1 deal. You'll only get to keep one of those checks. But don't forget, Luann, we help families talk about their VA disability, how that if you're not 100% VA disabled, your spouse is not going to get anything. So it's really important to make sure if you're 100% VA disabled, that your spouse understands that they won't get that whole check when you die, but they'll get DIC, Disability Indemnification Compensation. Then we also talk with families about their federal retirement. Are they going to take a 50% survivor benefit? Will they take a 25% survivor benefit? Will that affect their FEHB? What about if you're a state employee for the RSA or maybe the FRS for the Florida retirement system? Are you going to take survivor benefit? What does that look like for your spouse? All of these decisions are big, irrevocable, no mulligans, no redo kind of situations. Meaning if you get it wrong, you have to live, and even your spouse has to live with those consequences. So let's get it right. Let's have a professional take a second look. And that's why we encourage families, even if it's not us, that they always get a second opinion on their financial plan.
Exactly. Don't go it alone. You know, I have so many of my friends and acquaintances who just started taking Social Security at 62 because they were just sick of working, you know, and just started taking it. And I'm sitting here going, no, I wouldn't do that. You know, if I were you, I'd wait, you know.
You're like, I listen to a financial advisor all the time.
I know.
And again, that's where we're helping families say, hey, instead of taking Social Security, besides burning yourself out, why don't you just work part-time? Mm-hmm. Why don't we, sometimes we tell families they need to take it early, but they can only make up to that limit of $22,000, $23,000 a year.
Right.
And so we're helping those families not actually hurt their health trying to save and pay for health insurance, but helping those families navigate these decisions so that they have a long, prosperous life before retirement and after retirement.
And then on the other hand, I got to bring up this other friend. She only works part-time. So I was like, Dee, you should, look at me saying this, but you should go ahead and get Social Security now. You can have more income. You know, she was only working part-time, and her husband was like, what? I should not be giving financial advice, but
well, anyway. you're listening to one on a regular basis, so I'm sure it comes out, osmosis.
That's right. It's osmosis, yes. But you should not be listening to me. But anyway, listen to Andrew and come in and see him.
You're very kind.
But okay, so if people are worried about outliving their savings, because that is the number one fear of Americans today, again, what's your game plan for them?
Well, I mean, my game plan is to help them spend as much as they can without running out of money. I mean, so many families, they tiptoe into retirement, Luann. That's one of the biggest, gravest mistakes I see in retirement. They save all of this. They became frugal. They've learned the habit of saving. And when they get to harvest time, they don't bring out the sickle. They don't bring out the harvester to actually take the crop in. And I think how sad that one spouse is saying, no, honey, we can't buy that. Or she's saying, oh, we can't spend that. We can't afford that extra vacation. And then I'm saying, hey, no, I've proved it. You can spend an extra $2,000 a month without running out of money. Of course, you can take the $30,000 out for the Viking cruise and that trip to Ireland and that trip to Alaska. That's not going to derail the financial plan. And when families see that mathematical equations that their probability of retirement is still at 99% or 98% probability of never running out of money, then they can have the permission slip to spend more. How many families, Luann, that I've met with that said, Andrew, we haven't went on the Alaskan vacation, and I ask them, or sometimes I remind them of what they said earlier. I say, remember you said it was not a high priority to leave money behind to your kids. If you don't spend this money, they're going to fly first class with your money or give it to the Bolivian communists, some charity thing that you disagree with. So if you don't start spending your money and giving your money now, you might be surprised where your money goes when you're gone.
All right. So here's that phone number again, and we urge you to pick up that phone or even text this number, 800-848-8768. Call for a complimentary discovery visit. Get on their calendar. You can text the word SWAN if you like to text, 800-848-8768. Andrew, we still have a whole nother segment to get to, so we're going to take a quick break, but we'll be right back with more from Andrew McNair on What Your Money Would Say. Hey, thank you so much for spending part of your day with us today. I'm Luann Fulmer here with Andrew McNair. He's president and CEO of SWAN Capital. So it has been more than 15 years since one of the biggest financial meltdowns of our lifetime. And we're going to talk today about what we have learned from 2008. We're going to go into our What Your Money Would Say time machine, Andrew. So first of all, 2008, where were you?
This will be really funny for a lot of people. I was still in high school. I remember it because I was interning at a financial firm. And so I was witnessing families' 401ks turn into 201ks.
Yes.
I mean, it was quite a time period to live through.
Yeah, it was. So let's kind of go through just pop culture highlights. That's always kind of fun to go back to. So some of the top movies at the box office were The Dark Knight, Iron Man, Taken, and then Slumdog Millionaire. Which one of those was your favorite?
Oh, I mean, Iron Man. I love that movie. That was such a great movie.
That was probably the beginning, right, of all the...
That's the whole Marvel thing from there on.
Yeah, exactly. How about the Breaking Bad? It had its TV debut then in 2008. Did you ever watch that?
I'm not a fan of it. I'm sure it's great. I've heard many good things, but I know it's been on for like 5 seasons, so a lot of people love it.
Right, okay. Barack Obama elected president of the United States that year.
Of course. Yep, I remember.
And then this, and I know you, working in a financial firm, you knew all about this. Bernie Madoff, he was arrested, charged with securities fraud. They later revealed it to be the largest Ponzi scheme in history. And
Tragic.
Get this, a 90-year-old victim of his name was Ian Tierman. He was affected. Tierman told the Associated Press that his financial advisor gave him the bad news. I'm going to play this for you. It's so sad, but here's what the financial advisor said about Ian Tierman.
He said, my father, my mother, my aunts, uncles, we have lost everything. I have lost everything, and you've lost everything.
Isn't that the saddest thing in the world? That what
so
he
tragic.
Did?
It really is tragic, and this a lot of times happens when there's massive market pullbacks. The tide goes out, you find out who's skinny dipping, you find out what Ponzi schemes were really just a shell game, and so it's really scary out there. So when the markets are high, like we've experienced for a long time, this is when you start uncovering, when there's market volatility, what is not as it appears.
Right. Okay. So yeah, make sure you're working with the right financial professional. And you wrote a whole article about that. What is a good sign for people to look for to make sure? Okay, I'm good. I'm still good.
Yeah, I mean, we wrote an article, The 7 Questions to Ask a Financial Advisor, and one of them should be an additional question is, where are the money's actually held? Where are the funds held? Like, for example, we hired Charles Schwab to be our custodian. That's the checks and balance system. We hired Fundamental, which is a fund administrator. We actually hired a firm to audit our financials on our real estate investments. So again, you want to ask these questions. You trust, but you also verify. And that's why it's important to have custodians, fund administrators, and audits on your financial professionals.
Okay. We are in our What Your Money Would Say time machine, looking back at the year 2008. Here's a quick look at some financial figures. Home prices, they fell from 12.4% during the fourth quarter of that year. It was the largest year-over-year decline in about 30 years. Talk about that for a moment. I know you weren't in the home buying market then, but what do you remember?
What's so funny is I was going to buy my first duplex in about 2009.
No.
So I was going to buy it at the age of 18.
Wow.
And that was my plan because the market had dropped so much. And it is one of those rare events where the stock market had dropped and obviously the real estate market had dropped.
Yeah.
And usually those don't go in tandem. And so that's why it is important to have exposure to real estate and the stock market because they usually don't go in tandem. But it was such a financial crisis of our times. I mean, it was the Great Recession for good reason because both of those things happened at one time.
Right. And then, of course, inflation. Okay. Let's look at price of milk. Back then, $3.80 a gallon. That's still kind of expensive to me. Eggs, $1.99, very cheap. Bacon, $3.66 a pound. So we know we're going to experience the incline of prices for goods and services. Okay. But yet our income, it could stay the same. We just have to make sure we're smarter with our money. That's why the name of our show, right? What Your Money Would Say. So talk about inflation, how you and your team deal with inflation for retirees.
Yeah, I mean, most of our clients are about to be retired for 10, 20, or 30 years, and they're concerned with their money not being lost in a 2008 scenario. They've went through a 2008. They were working when that happened, but they remember it. It's still a fresh wound that if they go back and they think about it, they say, I will never want to go through that again. So what do most families do? They go to the opposite extreme. They say, I don't want to lose anything. And the problem is if you are in a safe investment, you're not necessarily safe. You're safe from market volatility, but you're not safe from inflation. So a lot of times we're helping clients, Luann, that have money in CDs and money markets to the tune of $300, $500. I met with a family this year that had $2 million sitting in cash. Ooh. And so that cash is on the sidelines. It's lazy money. It's not going to beat inflation long term. And a lot of families, they think, well, I'm worried about the economy. I'm worried about the election. I'm worried about our country. So I'm storing up cash. And I think, hey, let me shake you out of, into your senses. Cash is not safe. If there's a government collapse, your money is not even worth the paper. You should have bought firewood with your money. So that cash will not keep you warm. So it's important to invest in real assets, things like the stock market, things like real estate, things like private equity, and things that have had a long track record of beating inflation for the long term.
Okay, I want to go back to something that you said a moment ago about how, that the joke that the American 401ks became 201ks. Go into a little detail there.
Yeah, absolutely. I mean, most 401ks, if they were invested in the S&P 500, which a lot of them were, they had dropped 50%. A lot of people forget this, that the stock market lost 37% in 2008, but it actually lost 50% at its lowest cut. And that was a very scary time. But if you were wise, which many investment firms looked at that and they said, hey, if the market has dropped over 30%, we need to actually be in a buying position. And this is what we've been doing. We've been getting prepared. The market's at all-time highs at the time of this recording. So right now that it's at the all-time highs, we've been getting prepared for a market pullback. It may not happen for 3 years. It may happen in 3 days from now. I'm not sure, but we've been preparing. Why? Because all of the thermometers, the Schiller PE ratio, which I encourage you to Google, the Schiller PE ratio, which compares our company's price to earning ratios for all of the market compared to history, doesn't look good. If you look at the Buffett indicator, which compares our GDP, our gross domestic product of a country compared to our stock market, we're way over our skis at 202%, 2 standard deviations above historical trend. And if you look at the inverse relation with interest rates, you look at all of these parameters that shows that the market is overvalued, you need to start getting prepared for a potential market pullback. It may not happen for a while, but you'll be happy that you did.
Yeah, plan for it, which is what we are urging you to do today. Pick up your phone, grab your cell phone, wherever it is, put this number in, 800-848-8768, and you may call the team at SWAN Capital. Okay, get on their calendar. If you prefer texting, we make it easy on you. Text the word SWAN, and then you'll get a response back, and you'll get on their calendar that way. But you have the opportunity right now to get some guidance on your retirement, all these things that we talk about right now on our show. You hear us every weekend, and we know you're contemplating, and do it now. You may as well. Don't delay, because you're just a day closer to retirement right now if you're not already there. 800-848-8768. And remember our website, swan-capital.com. And you're listening to What Your Money Would Say with my good friend Andrew McNair. So happy to have you along with us. We are in the What Your Money Would Say time machine from 2008. Andrew, given what we went through in 2008, any lessons for people getting close to retirement today that they could learn from that?
Absolutely. So I sit across hundreds of retirees every year, and you'd be shocked how many times when we talk about 2008, they use the word had. I had a multi-million-dollar real estate portfolio. I had those homes. I had a really nice retirement, but I had to cash it out. And they're now just now almost to the point where they were sometimes in 2008. And to me, that's so tragic to go 2 decades just to get back to where you finally were. And this doesn't have to be this way. If you're closing in 3 to 5 years out from retirement, you need to start stockpiling in a G fund. If you're investing in the TSP, you need to start stockpiling in the stable value in your 401k. You need to be meeting with a financial advisor, looking at alternatives to the stable value in the G fund for your IRAs to make sure that as you close in on that chapter of retirement, that you are properly allocated. When the market is at all-time highs or at all-time lows, it is one of the best times to reallocate and rebalance. It's the free lunch of finances to rebalance and make sure that you're not overly weighted in one position. Maybe you've followed the AI craze. You've been lucky. You've made 100% return on your money, but don't let greed take over, because it will cost you. And you'll use the word had instead of have.
Mm-hmm. So true. Wow. This has been so fun to look at what was going on in 2008, more than 15 years ago, I mean, you look back, you think it was a long, like for me, I'm like, wow, that was a long time ago. My youngest was still in high school too. So,
Wow.
So
Yeah,
any final advice for someone who might be getting ready to transition into retirement as we close out our show?
Yeah, I would just not fall for any rules of thumbs. I have a lot of families, they're well informed, as I like to say it. They almost have too much information. They're like, I can live on 4 to 5%. I've done the calculation. I read an article. And the problem is that's not necessarily true. Like, the information that you learn online is good. You want to have a base understanding of different concepts and strategies. But the problem with even AI is that it can give you ideas, but it's not going to think for you, and it's not going to adjust to your situation. It needs to be customized. You can't just operate with a 4 to 5% withdrawal rate and hope it's going to be well. If you retired in 2000 or 2001 and you took out 4 to 5%, you may be running out of money today. And that's not the kind of retirement that I want to see for my clients. So if you want to make sure that you can sleep well at night in retirement, you want to make sure that you have the ability to sleep well at night in retirement, give us a call to take us up on that complimentary sleep study by calling 1-800-848-8768. Again, that's 1-800-848-8768 to make sure that you are prepared for retirement and will stay retired with your retirement plan.